listening to the Agent Survival Guide podcast, a podcast for today's insurance agents. Informing, educating, empowering, improving the way you do business in an industry that's anything but static.
In today's episode, licensed-only agents, or LOAs, can help scale your insurance agency growth. But are they right for your insurance business? Should you hire licensed-only agents for your insurance agency? Written by Emily Ryan. Hiring your first insurance agent is one of the most defining decisions you will make as a new agency owner. If you're debating whether to bring on licensed-only agents, or LOAs as we call them, you are not alone. Many new uplines wrestle with the same decision. LOAs can help you jumpstart your growth with experienced, ready-to-sell talent, but they can require more hands-on support, structure, and financial commitment. Let's break down the pros and cons of hiring LOAs so you can make the right move for your business model, budget, and long-term goals. A licensed-only agent is an agent who agrees to give up some of their commissions in exchange for support from an agency. In return, agencies provide leads, office space, marketing resources, and administrative support. LOAs are a type of captive agent. They have a regular income with a base salary and a stable paycheck. Instead of being captive to one carrier, like other types of captive agents, LOAs are tied to their agency as a downline agent. There are two types of LOA models to choose from when creating your business: W-2 or 1099. W-2 employees might receive a portion of their commission back, an hourly wage, and benefits. The exact compensation package is determined by the agency. This option offers the agency more control over the employee, but that control comes with higher costs to the business. Going the W-2 route is ideal for structure and stability. Alternatively, employees could be 1099 independent contractors, meaning they pay their own taxes and don't receive benefits. Agency owners have moderate to low control over 1099 contractors, but they come at a lower cost to the agency. Going this route is ideal for more flexibility and lower expenses. Now that we've covered payment structure, let's move on to the pros and cons of hiring licensed-only agents. We'll start on the positive side first. LOAs can enrich your insurance agency by increasing its production and generating new growth. Just think, when you have multiple agents signing contracts and meeting with clients, you could accomplish goals you couldn't reach on your own. As an agency owner, you'd start building your book of business. Uplines can maintain the book of business after an LOA exits, depending on the LOA contract. Using LOAs can also provide safety for agency owners because these agents are licensed and familiar with the insurance industry. And by bringing on a team of capable, knowledgeable, and experienced agents, your clients could be more satisfied with the customer service they receive. All in all, your team of agents will hopefully be more efficient than you could be independently. But there are some drawbacks of hiring licensed-only agents that are worth thinking through. By restricting the hiring process to LOAs only, you may eliminate individuals that could be good additions to your team. Additionally, to remain competitive, agencies often have to offer high salaries to LOAs. Lower labor costs are just one reason why many agencies opt to hire 1099 agents. Operationally, agents will need to have accounting or commissions software. This software can range between $10 to $50 per month, depending on software capabilities. You'd also have to have succession plans in place if an agent leaves. If you own the book of business, your agency will still be responsible for servicing the clients that the agent was responsible for. Will you bring on a new agent to replace the one leaving, or will you divvy up the clients among others? These are all important decisions you'll need to make. Should you choose to go the LOA route, it's considered best practice to write a formal LOA agreement or contract. This formal written agreement can help eliminate confusion and clearly outline processes, including how your partnership will work. Start by determining your LOA compensation structure. There are several pay structures you could choose from as an agency owner. We've got a few examples just for demonstration purposes. Say you go with base pay plus additional commissions. Maybe that looks like $2,000 to $3,000 per month. And then you add 75% of agent-level commissions on new enrollment. Or you could choose commissions only. This could be as high as 100% commissions or somewhere in the range of 85 to 100% of agent-level commissions. Maybe you'll offer bonus pay when it's compliant. And just a note, this is not permitted for Medicare Advantage prescription drug sales. Say you offer to pay a bonus of $250 for every 10 new enrollments in eligible plan types, or a particular eligible plan type in a single calendar month. You might want to offer performance incentives. This could look like tiered incentives for when your LOAs write over 25 new enrollments a month. And then maybe you'll offer something around renewal commissions, giving your LOAs 50% of agent-level renewals. And again, these are just examples. Ultimately, you'll have to decide what works for you and your insurance business. Another important consideration in your LOA contracts, you'll want to define who owns the book of business and if there's a vesting schedule. And what are the buyout terms if an agent leaves or retires? And then also important to include, be sure to outline specific non-compete policies and consequences if agents are found to violate the policies you set forth. Look into your state and federal guidelines surrounding non-competes because these policies can vary from state to state. You may need to bring on a legal advisor to help you create a contract for your agents. For W-2 employees, this agreement can be a part of their employment terms. For 1099 hires, you'll need to create a separate contract for them to sign. After you've created the contract, there are some additional planning essentials worth mentioning. We recommend thinking about the full life cycle of your LOA agents. Think about scale. How many agents will you have in your downline? What recruitment methods will you use? How will you handle expenses? What training will you provide on products, technology, sales, and so on? Also, what agent resources will you provide? Specifically, think about CRM software, commission payment and tracking capabilities, computers, office space, and leads, to name a few. Are your agents going to be using a platform to help them sell? Here at Ritter Insurance Marketing, the FMO that powers this podcast, we are also an integrity partner. That means we offer Integrity Connect for free to agents and agencies appointed with us. Integrity Connect, if you haven't heard of it, is an enrollment tool that agents can use to quote and manage clients in one platform. When your agents are ready to sell, are they going to be handling appointments on their own right away, or will they shadow a more experienced agent for a few appointments before taking the reins? Perhaps you plan on taking a mentor-type role in your agency. Whatever you determine is best, Make sure you practice the same onboarding procedures for all new LOAs. Overall, an LOA requires more hands-on effort from an upline to ensure success and to encourage client satisfaction. If a client enjoys the service they provide, they're more likely to stick with the agency, thereby incentivizing downline agents to stay for years to come. And developing strong agents starts with you. To encourage your agents to blossom in your agency, think about personal and professional development for your downline. Implement a regular meeting plan, perhaps bi-weekly or monthly, to establish goals and check progress. Some great goals to help your downlines include setting a specific number of contracts or sales, total production, year-over-year growth, earning a carrier trip or recognition, even attending specialty industry events like our Ritter Summits. We also recommend that you implement a strategy so you and your agents reach out to your clients for reasons other than sales. This could look like checking in with clients about their coverage, wishing them a happy birthday, and celebrating anniversaries. These kinds of communications, without an ask tied to them, build strong client relationships and loyalty. And when you set the example for your downlines by practicing these retention efforts yourself, it is a win-win. Now that you've heard the bulk of this episode, it's time for me to ask, are you prepared to build an insurance agency with LOAs? If you're confident in your next steps, you understand why LOAs are the best move, or you've made meaningful decisions to set your plan in motion, you're ready to build. If you need more guidance before moving forward, maybe you're unsure if you can do this on your own, or you think another business model might be a better fit, it's probably worth taking some more time to think through your options, and that's okay. An important note that I do want to mention here. Unfortunately, some carriers don't allow LOAs. This is typically a rare instance, but you should be aware that they may not be able to work with all of the carriers you would like to if you choose this model. Additionally, continuing education credits are a requirement for health insurance agents, including LOAs. It'll be up to you to decide if you're going to compensate your downline for that or establish a way for them to receive their credits. Really think about the amount of time and support you're able to offer. Are you busy with your own clients? Or are you focused on dedicating your time to growing your business and supporting the agents in your downline? Choosing to hire LOAs for your insurance agency is a great next step to a flourishing business. We hope the tips and questions we've posed help you to make decisions for your downline that will lead to success. And if you're interested in forming an agency with the support of an FMO like Ritter Insurance Marketing, reach out to our agency team to discuss your options. We will have the link in our episode notes. Thank you so much for listening to this installment of our Agent Survival Guide podcast. We will see you next episode. The Agent Survival Guide podcast is a production of Ritter Insurance Marketing, an integrity company. This episode was written and proofed by Emily Ryan. Recording and production by me, Sarah Ruppel. Podcast design and episode artwork by Urban Rivera. Follow along with our show wherever you like to listen. Rate and review our show on Apple or Spotify.